And Josh Brown, I start today with this note from J.P. Morgan's Marko Kolanovic. He is a guy closely followed on Wall Street. He says the next leg higher is likely upon us right now. He says to stay overweight cyclical and inflation-linked assets. 4,400, his S&P target for the end of the year, basically says, look, all's good. After sideways trading, now we're going to really start to move. What do you think?
So I missed the part where he said, like, things weren't going to be good. So fortunately, I didn't do anything. And I guess I won't do anything this time now that he says we're all good for the breakout. Look, I just follow price action. And price action has kept you in this market for almost 15 months now. And anyone that says otherwise doesn't understand price action. And the reason why price action is so important to follow, Judge, more important than commentary, opinions, feelings, rhetoric, is because it literally gives you a real-time sense of what buyers and sellers are actually doing with their money. That's their vote. That's where they're betting. So anybody can say anything. So here's what I look at when I'm looking at the market right now and trying to understand what's happening with price. I have a 52-week high in the XLE. If I had told you we would see that 6 months ago, you would have laughed, given the condition those stocks were in. I have new all-time record highs for small cap value. The financials are hanging right near highs. The longer they stay up here at the upper end of the range, the more likely a breakout is to occur. Massive comeback in some of the speculative areas of the markets. The SPAK ETF that tracks SPACs, for example, is up about 20% off its lows. The meme stocks are memeing. And then I look at REITs. And REITs are just having a major moment as investors seek some protection from the idea of higher prices in the economy. And REITs just continue to find dollars. You can track that via the VNQ, which is Vanguard's REIT index, or the IYR, which is the Dow Jones version. Both ETFs are going higher, have been for quite some time, outperforming everything. Last but not least, Facebook all-time high today. The breakout is legit. Alphabet looks amazing. I told you I think Amazon is consolidating, ready to make its next move higher. This is the condition the markets are in based on price. You can have any feelings you want about any economic data. I'm telling you what the buyers are doing.
Okay, so Stephanie Link, it's cut and dry, right? As Josh said, Kolanovic says the positive outlook should last at least during the summer months, peak reopening, what he calls it, but potentially well into 2022. Does that make sense to you? I mean, we've had a sideways chop. There seems to be more trust in the Fed by the market. Vis-a-vis rates are not running away, backing up too far anymore, and they don't seem to be scaring anybody anymore. So that seems like to be a pretty good environment.
It is a pretty good environment. We've been talking about this for quarters now. So the economy is definitely on the mend, right? And it's because of the stimulus. It's because of the reopenings. It's because of the vaccination rates. So far, the interesting thing to me is so far, the recovery has been led by manufacturing. We talk about PMIs, ISMs, durable goods. We talk about CapEx spending starting to turn. It's 12% of U.S. GDP. And so we've been very positive on manufacturing. But now you're starting to see services kick in. And we're getting a whole host of data points from the government, but as well as from companies, that services is actually doing better than expected. The ISM services hit a record last week. ADP and non-farm payrolls both led job growth from services. Companies like GM last week, Airbus, Southwest today, Schlumberger last week with rising earnings estimates. So we're hearing it across the board. So if you add up manufacturing and you add up services, that's a nice tailwind for the economy and for it to stay strong. In fact, the World Bank actually came out today and expects 5.6% global growth. That's the best in 80 years. So it's not just the U.S., it's around the world. And so you absolutely want to have cyclicals and economically sensitive companies. But to Josh's point, there are some great FANG names out there and secular growers, and you want to have exposure there. I am worried about inflation because I really don't think it's transitory. We've talked about this. I think it is on the commodity side. But when I hear the NFIB chief economist today saying that wages are going up because people can't find people to work, that's worrisome. And that you add on to unit labor costs going higher and the ISM prices paid index at the second highest on record. So all of these things are worth watching. And that's the one trouble spot in my mind.
Okay.